Today marks 2 years since Silicon Valley Bank's collapse sparked a mini crisis in the regional banking sector. But just last week, financial stocks saw their worst session since the collapse. So how safe are banks in the current economic backdrop? Joining me now, we've got Ken Wilcox, who is the former Silicon Valley Bank CEO from 2001 to 2011 and author of the China Business Conundrum. Great to have you here in studio with us.
Well, thank you so much.
So let's dive into this a little bit, because I think more generally and broadly here, 2 years since the Silicon Valley Bank collapse hit financials, how is the financial sector now in those lessons learned, the recovery, and now the outlook for the future?
I think the financial sector is doing just fine. I think it's in better shape than it was. And as far as I can tell, the future is reasonably bright.
And so within that, what are the red flags that we should be looking out for to make sure that if there is ever another event like Silicon Valley Bank brewing, how we would be able to anticipate it?
You know, that's a difficult question, because I will admit that I had absolutely no idea that this was brewing at Silicon Valley Bank. I was in North Carolina visiting my son in the Marine Corps at the time, and I picked up the newspaper, figuratively, obviously online, and I almost fell off my chair. I did not expect that at all. So I spent a lot of time looking back and trying to figure it out. It could have been anticipated, but it would have required, I think, a financially astute observer, and they would have had to study the financial statements. And the financial statements were available. I think the key there would have been noticing two different things. One was, in the course of 21 and 22, a rise in deposits. Number two, a rise in the bank's investments in long-term interest-bearing securities. And number three, a rise in interest rates. And if a financially astute observer had been looking at those things, which were all available,
right,
they could have figured it out.
And so with that in mind, are there any of the similar instances of banks right now where because those financial statements are also available, is that kind of taking place at any of the other institutions from what you can measure at this point?
Well, to a certain extent, yes, but I think that those other institutions have taken precautions in the meantime in one form or another. So I don't see anything that's likely to blow up at any time in the near future. I'm just saying that in that particular case,
sure,
I was not in a position to figure it out.
And so all of this in mind, it was a larger, not just campaign, but also a larger messaging that we were seeing from the financial services sector to remind consumers about the safety of the banking system. How successful has that been? Has it been successful? And our regional banks, the ones that are able to operate in any environment, and especially in this environment, does it seem like they have proven to consumers that they are safe to continue to transact with?
I think so. I think in a general sense that's true. I would also like to insert here, just to be clear, in Silicon Valley Bank's case, it was not the business model. It was a big error made on the part of what I'd call the Treasury, the CFO, in terms of taking excess deposits and investing in long-term interest-bearing securities. But in general, I think the financial sector has learned a lesson, and for the time being anyway, is taking the necessary precautions. That said, I think consumers need to always be ever alert. They need to do their best, become financially sophisticated. They need to listen to folks like you here on Yahoo Finance, and they've got to just keep reading and questioning.
Yeah. And so with that in mind, what should the average consumer or average bank customer know watching and being a part of the system that's playing out here in 2025, if they are kind of going down their checklist of how to make sure that they're managing finances and making apt money decisions, knowing how the banks themselves are navigating what is a quickly fast-paced and changing environment, both geopolitically as well as for their businesses?
Well, I think, first of all, if you're talking about the average consumer doesn't have enough money in the bank to spend that much time worrying about it, nor do they have a lot of excess time to become financial experts. I think where this plays a real role are in situations that I sometimes see now in my current role, advising some charitable organizations. And what happens there is a charitable organization has a bank account that's bigger than an average consumer, but not gigantic like a corporate company would have. And they're wondering, where should we put this money? And they seem to, and this is something I've encountered more than once now, they seem to see a trade-off between being with a big bank, which probably is strong enough and stable enough that could weather almost any storm, and on the other hand, being with a small bank where they feel they'll get more attention, maybe a higher level of customer service because they're not that big to begin with. And those people, I think, would be well served to pay attention to reports that are issued by places like Weiss and Bauer, maybe Keith Brewett would and read those reports.
Yeah.
And reading those reports will tell them what they need to know.
Ken, just lastly, while we have you here, we were talking in the break about your book that's out, and congratulations on it as well here, The China Business Conundrum. As you look across what's playing out within the tariff tit for tat and geopolitical landscape, what more extremely are you monitoring at this juncture?
Yeah, with respect to the geopolitical landscape, that's a very, very tough one because we have, on the one hand, our new president, and on the other hand, we have Xi Jinping. And I would say that China likes our new president for a couple of different reasons and is not that favorably disposed toward him for a couple of other different reasons. On the negative side, they think he's very volatile, unpredictable, and prone to a lot of drama. And on the positive side, they think that he's a businessman and that he will engage in deal doing. And they're looking for an opportunity to do deals.
Interesting.
Trade-offs.
Right.
You do this for me, I'll do this for you.
Certainly. Ken, thanks so much for taking the time here with us today. Really appreciate it.
Thank you very much. Let me just say one more sentence, and that is, I wish SVB all the best. They're good people.
We appreciate it.
Financial stocks seen their worst week since the collapse of Silicon Valley Bank last week, 2 years on from that crisis. How is the financial sector poised to handle any potential growth slowdown to come? For more, I want to bring in Chris Whalen, Whalen Global Advisors Chairman, to discuss. And Chris, it's great to speak with you. March 4th, again, that worst day for financials since the collapse of Silicon Valley banks. What thesis are you deriving from that?
Well, I think Scott Besson said it very well. It was a supervisory lapse, but also a lapse by management. Many people were, I think, faked out by the Fed during this period. We kept hearing about transient inflation, but the market risk created by the Fed's open market operations was enormous. And even today, you see the effect. We just published a list of banks looking at their yield on their mortgage books. And people like Charles Schwab, Bank of America, PNC, Truist, they all have very low yields. And you ask yourself, why haven't they restructured? Because it hurts earnings. It's not the mark-to-market that's really the concern. It's that you have a lot of securities with 2% coupons that are a point underwater. And so in the case of Bank of America, it's going to hurt them a lot over time because they're not really restructuring. There are other banks like Key, Texas Capital, Pinnacle Financial. They've all restructured. They bit the bullet, sold the low coupon paper, sometimes at a 10 or 15% discount, and then they reinvest at a yield that's twice as high. And over time, it very quickly makes up for the difference. So that's really, the takeaway. And the industry still hasn't dealt with this. They're still waiting to be rescued with lower interest rates. And as you know, now we're waiting, and we may not see any rate cuts in the first half of this year.
Chris, you focused a lot on the balance sheet and the way in which different banks have looked at managing risk on their balance sheet. Talk to us about operating models. In the wake of Silicon Valley Bank, I remember there was a lot of discourse around are regional banks on secular decline, and we're going to see the rise of the big banks, and it's going to be scale wins, the big get bigger. Talk to us about that dichotomy, and if there really is one.
I think there is to this degree. You have to be bigger. 10 years ago, you could have a $5 billion community bank and be quite viable. I think you got to be 20 today. So there is a lot of forced consolidation at the bottom of the scale. And you see a lot of $5 and $10 billion banks merging because they realize that in order to compete, even just to maintain their market share, they have to get bigger. So that is definitely a concern. The model of Silicon Valley was not typical. It was a very atypical business model with a large chunk of mortgage-backed securities on the balance sheet, almost half. So I would say that was a red flag. My attitude is that most banks shouldn't own mortgage-backed securities. They're just too complicated. The interest rate hedging, the volatility, the convexity of the security often gets people in trouble. And you can see what it's done to the Fed. The Fed is deeply insolvent because of their own investment in mortgage-backed securities. So I think, the takeaway here is be careful of complex securities that you may or may not understand.
And Chris, I wonder too, when you mentioned the merging of some of those smaller banks, what is that telling you about the health of our economy, the health of the consumer? Do you think there are any flashing warning signs right now in the activity we're seeing among the banks? And also, again, I mentioned the stock performance of financials over the last week. Is there any economic risk that is painting for you?
Well, look, the financials had an amazing run over the past year. JP Morgan, I think at the peak was 2.5 times book value. They're around 2 today. The consolidation you're going to see among smaller banks, as I said, is just driven by size issues and by the ability to compete with the 10 or 15 banks that represent 70% of the assets in the industry. They have a big advantage in terms of funding. Look at JP Morgan. I mean, they have an enormous advantage, even over the other top 10 banks in terms of their performance. So they have set the bar very high. I think the real issue going forward is going to be the different business models. You have the asset gatherers like the Morgans and the Schwabs and the rest of them. The Main Street Bank, I think, is going to have to evolve rather significantly. During the Trump administration, you may see them get back into mortgages more. Many of these banks have run away from government lending. So there are some changes that are going to occur. But I think mostly on the margins, it's about size. You want to be at least 20, maybe $50 billion to survive in a marketplace that's, $15 trillion in total assets.
Yeah. All right, Chris, thanks so much for breaking that down for us. We appreciate your time this morning.
My pleasure. Have a great day.
Me too.